All right. Hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our options weekly recap. What I want to do in today's video is to highlight a very active week that we had last week, walk you through how that impacts trading going forward into this coming week. We'll also take a look at some trades that we're looking at going into early next week, trades that are potentially setting up for us in what we expect to be another very active week next week. So let's start by talking about our daily chart of SPY here. This is the S&P 500 ETF. It's the chart that we like to look at to gauge overall market environment. How bullish or bearish are we? How aggressive do we feel comfortable being in the sessions to come? I have a variety of different moving averages on this chart, just a mix of different simple and exponential moving averages. We've also got our volume average down at the bottom, as well as the ATR, or the average true range. This chart here, it gives me a good glimpse into the overall market direction. SPY is a pretty good indicator of what the overall market is doing. I don't use this chart to trade off of. It's not something that I'm looking at for entry and exits. What I am using this chart for is to gauge how aggressive I want to be here going forward. What I'm looking at here from this past week, it was a very active news week. Obviously, we had all of the news associated with the elections here in the U.S. That was dominating the headlines, and price action had a very impressive week, no doubt about it. Markets do not like uncertainty, and as we continue to get more clarity from the outcome of the elections, markets really cheered going into the end of the week. I mean, we saw a very strong week. We also had the Fed news, the Fed meeting last week. We had a Fed statement on interest rates. Normally, that is just a big headliner, but it definitely took a back seat given all of the election news last week. But going into this coming week, it's going to be a slower week news-wise. Yes, we're still going to have some news from the election outcome and so forth, but I do think we'll see a shift back more towards a technical approach, focus more on price action on the charts. And from a technical perspective, here's what we're looking at. If we take a look at this daily chart, you can take a look at the last 5 trading sessions, and it's been just another rocket ship to the upside. We did stall out here towards the end of the week, just above the 350 level. If you go back to our videos from the last week, the midweek update video last week, we talked about key areas of resistance. The first one, being around this between 350 and this swing high right around 353.5. I mean, that was an area that we highlighted last week, and we did stall out right in that range to end the week. Now, if that level breaks, if we get another wave to the upside, we still have the upper end of that swing high right around 354. And then you've also got the all-time high, which is up at 358.75. Those are going to be levels that we'll want to watch for resistance. I'd be very surprised if we broke right up through those without at the very least a pause. I do expect us to pull back from there. In a perfect world, I would love to see price action pull back to start the week. I'd love to see a sell the news type of an event where we get a pullback, ideally into the moving averages below us. If we can get a pullback into that level, it could build energy for another wave to the upside. It could come down and test the support levels right around 341, 342-ish. If we test those levels, it could potentially be that trampoline effect where we come down, test support, bounce higher, and during that pullback, we're building energy for another potential push up towards those all-time highs going into the end of the year. That is just one scenario that I could very much see playing out. Now, let's say we do get that pullback, but it ends up going deeper than expected. We have this whole cluster of moving average that we just broke up through on the upside last week. We've got this whole range from around 342 all the way down to around 330-ish. That's a whole cluster of support levels. It's going to be difficult to break through those levels without, seeing chop kick in there. So those are going to be areas that we'll want to watch on the downside should we get any type of selling next week. The volume continues to be pretty darn good for most of the past couple of weeks. We've been stuck between 70 and 100 million shares. That's a pretty good range. It's a range that is going to make it easier for us to get fills on trades. We got follow through on the upside last week because the volume on the upside was pretty good. That's been a missing piece on a lot of these moves to the upside of late. They've all come on lower volume. until last week. The volume definitely confirmed the move. We also saw the ATR, or the average true range. If you go back a couple of weeks in our recap videos, we had talked about how that average true range had been contracting, and we wanted to see it expand again. And that's exactly what has happened over the past week or so. The ATR is now pushing up towards that 7 level. That's a very good number, indicating very good range intraday, very tradable range in a lot of different areas. Want to see that level stay elevated. We don't need to see a one-way move higher. Ideally, now that we're overbought, which I'll talk about in just a moment, I would love to see some better two-way action. I'd love to see some better back and forth. What we don't want to see is just the one-way move higher. Just as much as I don't want to see the one-way move lower. The back and forth movement for an options trader is really ideal. So I'd love to see some two-way action going into this coming week. The VIX, if you take a look at VIX, that is the volatility. It's a gauge of volatility market-wide. It did, over the past week and a half or so, it did briefly get up in the upper 30s, even touch 40. We saw volatility contract in a big way last week. On that rally to the upside in price, we saw volatility get crushed. We're still above 20. 20 is still a historic high level long term, but the volatility has contracted significantly over the past week and a half because we're starting to get past some of that uncertainty, starting to get past the elections and potentially what's going to happen with more stimulus. Some of the headlines have started to slow down a bit. We're also through earnings season. There was all of the unknowns as to how much of an impact the pandemic has had on the earnings. We're past the heart of earnings season. So now they're starting to suck the volatility out of the market, which seems like a good thing. But we want to make sure that volatility does stay active. I want to make sure that we have good range back and forth. What would be a good level? I want to see the VIX ideally stay in the upper teens to low 20s at a minimum. That would be great. But we'll just wait and see what happens here going into next week. So if we take a look, if we go from this daily chart, which is certainly leaning bullish, I mean, it's hard to lean anything but bullish here in the near term, we are overbought. Okay, I mean, you can see it was in the last week, just over a week. I mean, we have gone from 323 all the way up to a high last week of around 352. And that's a huge move. So big picture going into the end of the year, again, it's hard to lean anything but bullish just given price. In the near term, if we go over to the 195-minute chart, this is the chart that I actually like to use for my trade signals, for my entry and exit points. You'll notice that we are overbought in the near term. It's not an area in here that I really want to initiate new long trades. I mean, the system is in a long setup that did trigger in last week. Our trend strength indicator went from red to blue. We did get our blue plus signs. Price action had confirmed on the upside, and the system did get long at 348.48. It's a tricky level to get long here, because the market is overbought. It's made an extreme move. It's tired. We could very well see that pullback that I talked about a few moments ago. Not opposed to getting long, but when I see a move like this, where you see a 4 or 5 day stretch with an extreme move in one direction, this is a situation where I have to respect my system. I have to respect that long setup. So I'll start to scale into a position, put on a smaller position size than normal, with the expectation that before we get a big push to the upside from here, we could get a pullback first. We could get a pullback into our 8-period exponential moving average. That's that red and blue line here. Or even the 50-period exponential moving average, which is the white and yellow line. So why would I put a position on at all? Again, I have to respect the system, and anything can happen. Even though I would love to see a pullback first, what if it doesn't happen? What if we just continue to see that rocket ship move to the upside? I want to have at least part of a position on to benefit from that move. I'm not willing to get ultra aggressive with 100% of my normal position size because we are extended. So I want to prepare myself for that pullback first. So I have a long position on here, but with a smaller position size. I would love to add to it here next week, depending on what price action does. Now, if we go over to the trade page, I started to touch on this last week in the midweek recap. For the last number of weeks, I have been trading a lot of the November monthly options. The problem with those is they are now down to 12 days left before expiration. From here on out, the time decay is extreme. You've got to be cautious with those. With a lot of my new open positions, I am starting to go all the way out to December. The December options have 40 days left to expiration. In most cases, when I'm buying options, I like to use the options that have between 20 and 40 days left. Those December options, as of next week, are now going to fall inside of that range. So a lot of my new positions from here on out are going to be focused on the December monthly options. The only exception to that would be if I take a look at some credit spreads. If I'm looking to sell a vertical spread, which we'll talk about in just a moment, I would be open to using some of those shorter term weeklies as long as the liquidity is there. So I'll talk about that more in just a moment. But any type of a long option or a debit spread, for me, over the next few weeks, I am going to be focused on the December monthly options. So that trade last week, towards the end of the week on SPY, we were looking at either the 348 or the 349 calls. Very liquid markets, very high open interest, very high volume, so you shouldn't have any problem getting filled. The only trouble with these options is they are pretty expensive. You're talking about over $1,100 a contract. Reason being, the VIX, the volatility is still elevated. Even though it contracted last week, it's still high, and we're also going out 40 days, which is near the longer end of the spectrum for us. So they are going to be a little bit more expensive. You can potentially turn this into a debit spread as well. Have no issue there. But at least on the current position that we're looking at, I am looking at the long calls, looking at the long 348 call options. All right. So that is how we're playing that SPY trade. QQQ, the NASDAQ was on an absolute tear last week. The tech stocks, after pausing, going through the earnings season, I mean, they just took off all of last week. Very similar chart pattern to SPY. The trend strength indicator flipped from red to blue, indicating bullish momentum taking over. We also saw price action break up through both the 8 and the 50 period EMAs, confirming the move to the upside, and this long trade did trigger in. Here's the difference here. Notice how QQQ, we had our long setup right here, these blue plus signs, that indicates a long entry point, but we actually gapped up above that entry point last week on all of that headlines, all the news out of the elections last week. We actually gapped above the entry point. So I didn't grab this long setup as of yet. When I see a gap above the entry point, I don't want to chase. I don't want to chase a trade because chasing trades can lead to very inconsistent returns. In the heat of the battle, when you see that move happen, you see a gap above the entry point, it's difficult because you feel like you're missing out on the move, right? And it's tempting to just want to chase the move. You've got to fight that urge. You've got to wait for a pullback first. We need to see price action pull back into that entry point before we jump on board. Now, I didn't mind that I missed the trade initially last week because, again, I would like to see a pullback first before chasing another move higher. All right. So what I am waiting for is I want to see QQQ ideally get back to 289.29. That's the blue plus sign right here. I'd like to see that level touched before we jump on board anything new. Okay, so that is my plan of attack on QQQ. I'm tentatively leaning bullish, but looking for a pullback first. So in other words, in the very near term, I'm neutral, looking for a market pause or a pullback. But if you start to go out a couple weeks, I would be surprised if we did not get another leg to the upside. So I'm looking for a potential long trade, but I want to pull back first going into next week. Speaking of some of the tech stocks, let's talk about Apple and Microsoft here. Apple also had a very impressive move higher last week, but it's a very similar looking chart to QQQ. We did get our trend strength indicator to flip from red to blue. Bullish momentum taking over. Price action did confirm above our moving averages. And we did get this long setup here, and with an entry at 115.81. The problem was we saw a gap above the entry point here, unfortunately, on the election news last week. I missed the setup initially. I'm waiting for a pullback. I would love to see price action pull back into the moving averages first. That would kill two birds with one stone. Number one, it'd give me a pullback to potentially get on board that trade right around the initial entry point. It would also allow that energy to build. Again, I've already talked about it a couple of times. If we can get a pause, if we can get a pullback into some of these moving averages, it will just build energy for a more sustainable move to the upside. If we don't get that pullback, I think it's going to be more difficult for this market to make a sustainable move higher from here because it's already made a heck of a move. It's tired. So I want to see that pause early next week. That would be ideal. If we get that pullback into the entry point, again, entry point on Apple is 115.81. What I'm looking at here is if I go over to the trade page again, we are looking at the December monthly options, just like we talked about on SPY earlier. And pulling up those options, what I'm looking at is the 115 calls, okay, would be the at the money calls. Okay, if price action pulls back to the entry point. I realize that price closed last week at 118.69, so we're well above the entry point. So those 115 calls are actually in the money at this point. If price action pulls back in and hits our entry point at 115.81, I'm going to be looking at the 112.5 calls. Why? Number one, we're going out to the December options that have 20 to 40 days left, but I also want to get 1 to 2 strikes in the money from the entry point on our chart. The 112.5 calls would get me 1 strike in the money. Okay, that's what ideally I'm going to be looking for going into next week. So if we get a pullback into that 115.81 range, the 112.5 calls out in December would be a trade of interest for me. Okay, so that's something that we'll be watching here to start the week. If the trade does get back to the entry point and we do take the setup, our stop would be down at 118.58. So if we do get the trade the trigger in and pull back on us and it ends up stopping out, if price action gets down to that 109.88 level, we take the position off. On the upside, what would a target be? Any type of a long option, we always start out with 100% target level. I'm looking for a double. So if we pay $9 for the option, for example, I'd be looking to close it out at $18. I'm looking to double my money. Okay, it doesn't guarantee that we're going to be able to do that, but that's my initial target. And then as we go forward over the next few days, once the trade triggers in, we can always evaluate price action on the chart. And if we decide that, hey, we're going to take the trade off before the 100% target levels hit, we can certainly do that. Microsoft. Little bit different story here on Microsoft in that price action has had a move to the upside, yes, but look at our pulse indicator. It's the red and yellow histogram down towards the bottom. It flipped from red to yellow here towards the end of the week. And when I start to see a whole series of yellow bars on the pulse, it indicates that price is between a 1 and a 2 standard deviation move on the upside. In other words, we're overbought. It does not mean that Microsoft can't move higher from here. It doesn't mean it has to completely fall out of bed. It just means we're at a price point where we will typically see either a period of consolidation or even a reversal in the other direction. If we go back and look at all of these previous instances where price action got overbought or oversold, all of the situations where you saw those yellow bars on the pulse, look what price did shortly thereafter. Price action on the downside got oversold, we reversed higher. Price action got overbought in the near term, reversed to the downside. Price action got oversold. We had yellow bars on the downside. Price action reversed higher. This is a very repeatable pattern. Again, it doesn't guarantee it's going to work. It just means we're at a level now where we're overbought. Typically, price action will get tired from these levels. Now, because we saw those yellow bars, I typically look for 3 out of the past 5 bars plotting yellow. That does not mean that I'm looking for a long put. Buying a long put here, expecting a pullback, for me, the problem with that approach is buying a long put only gives me one way of making money. We'd have to see Microsoft move lower in a hurry. I'm not convinced that that's going to happen. I want to look for a pause. I'd look for a period of consolidation, but I want to take the trade with a more conservative approach. We can do that by selling a credit spread. So let me switch the symbol over on the trade page from Apple to Microsoft. And we're going to take a look at selling an out-of-the-money call spread. Selling a call spread is a way for us to lean neutral to bearish. It would benefit from Microsoft even moving either sideways or moving to the downside. So let's go out to the December monthly options. And I'm going to go out to the 230 call. It has around a 65% chance of closing out of the money. I'm going a couple strikes out of the money here. I'm going to right click on the 230 call, go to sell and select a vertical. That is going to pop up an order down at the bottom where I am selling the 230 call and also buying the 235 call at the same time. We're trading two different options at the same time. Right now, it's trading for $1.62 mid-price. Let's say we can get filled there early next week. If I get filled at $1.62, let's look at the order confirmation box. The $162 that I'm collecting there is the most I can make on the trade. It's my max profit potential. My maximum risk, my max loss is $338. I'm right around risk 2 to make 1. I'm okay with that ratio because we've got 5 ways of making money on the position. I make money if Microsoft moves up, down, or sideways as long as price stays below 230. In fact, we're going to take it a step further. My actual break-even point's at 231.62, and that level there is calculated by taking my 230 call option that I'm selling, and we're adding on the $1.62 credit that I collected to put the trade on. So ideally, we want Microsoft to stay below 231.62. It closed the week at 223.72. We've got about an $8 cushion here where I can be wrong directionally and still make money. The only move that hurts me is a move above 231.62, but we're not expecting that because price is already overbought. We just talked about that. We make money if Microsoft moves up, down, or sideways. We also make money if time decay adds up, which it will every day. Every day that passes, the time decay is going to add up in our favor. And we make money if volatility decreases. Now we've got 5 routes to follow to make money on the position. Whereas if I just buy the long put, I have one way of making money. This is going to give us a higher probability of success. It's a smaller profit. Our max profit is $162. It's a smaller profit potential, but we're also tying up far less capital. If I just come in and compare, we're tying up $338 per spread to put this position on. If I buy a long put here, if I go to an in-the-money put, you're talking about over $1,000 a contract. We're drastically reducing the cost of the trade. It's going to give us a safer position, tie up less capital, and give us a higher probability of success. I'm not saying you should trade credit spreads exclusively, but it should be a part of your trading. It's a great way to diversify, especially if you're somebody with a smaller account size. It's just a better use of your capital. So that's a trade that I'm looking at on Microsoft going into next week. Now, everything I just mentioned on Microsoft, if I take a look at a market like Snap, which is Snapchat, go ahead and load that chart up. Everything I just mentioned on Microsoft holds true on Snap as well. We have had yellow bars on the pulse indicator going back into the end of October. Going back to the session on October 22, we have seen yellow bars on the pulse indicator pretty much every day since. We are very overbought here. So is this a candidate for selling a call spread just like we did on Microsoft? Absolutely. It doesn't mean price can't move higher here. We've seen that it has continued to move higher. It just means it's not statistically probable that's going to make a big move higher from here. The odds actually favor either a period of consolidation or even a reversal in the other direction. So this is another candidate for selling a call spread next week. Some of these tech stocks are overdone on the upside, no doubt about it. Let's give an update on the financials and energy. We talked about these the last couple of weeks on how we really needed both of these sectors to kick it in. For a leg to the upside, we really needed to see the financials come to life as well as the energy stocks. The financial stocks, they did. It wasn't an explosive move higher like tech, but you can see on XLF, we did get a nice bounce from around 23.25 all the way up to a high last week around 25.5. That's a pretty nice move. The trend strength indicator did flip from red to blue, indicating bullish momentum taking over. Price action did firmly close above our moving averages up top. So this is a trade that did trigger in 25.15 was the entry point. Our stop is down at 24.24. This is a trade that could still be taken next week if we get a higher open. It's still a trade that's on my radar. I would still like to see the financials pick it up a bit on the upside. So potential long call options out in the December monthly options, definitely a route to go on XLF, definitely of interest going into next week. And then XLE, this is the energy ETF. The energy sector continues to have a very difficult time getting out of its own way. We had a brief bounce last week. That bounce went right into the 50-period EMA, that white and yellow line that I'm highlighting here. We saw price action stall out all right there. We found very significant resistance right there, and we did roll over to back to the downside into the end of the week. Our trend strength indicator flipped from blue to red, indicating bearish momentum taking over. We did see price action break below the moving averages, And we did get this short set up with an entry point at 29.04. That trade did trigger in. When I say a short entry point, I'm talking about a potential long put position here. Once price action hit 29.04, we're looking to buy long puts out in the December options. I was looking at the December 30 puts. Get me slightly in the money. They have plenty of liquidity. That's the way that I'm playing this potential move to the downside. So if you notice here, we took a look at a mix of markets, ETFs and stocks. We took a look at a mix of strategies. We talked about some long calls and some long puts because ultimately we don't know what the market's going to do next. I don't like being 100% bullish or 100% bearish at any one time. I like a mix of trades so that way we can react to whatever the market decides to do. We also talked about some credit spreads. So you start to mix up your strategies. That's going to give you more consistency. Where I see most people struggling right now is you fall into that 100% bullish camp or 100% bearish camp with no middle ground. You want to make sure that you are open to whatever the market's going to do. The market likes to surprise as many people as possible. So be open to any type of scenario, even though it's very difficult, right? And I've been talking to a lot of people lately about how you almost have to think like a criminal right now. Right? Because if you take a look at this market logically, it should not be as overbought as it is. It's at very lofty levels. And considering the uncertainty that's out there, considering what's happening with the pandemic, still very unusual to see this type of strength. But had I been 100% bearish here, just plain, hey, this market has to pull back. It can't potentially, move higher from here. I'd be in trouble. So you want to be open to whatever the market's going to throw your way. Bottom line is we care more about making money than being right. And if I'm dead wrong on what I think the market's going to do long term, that's fine as long as I'm trading off of price action on the chart and potentially setting myself up for a bullish move. So bottom line takeaway there, be open to anything the market throws your way. Look for a diversified approach, meaning a mix of markets, a mix of stocks and ETFs, a mix of different trade types. That's going to produce the best consistency long term. So going into next week, again, would love to see a pullback in the near term, potentially build that energy for another wave to the upside. So we'll see what happens. I'll be back next week on Wednesday for a live session. I apologize, this wasn't live on Friday. With the markets so active, I just was not able to get on for a live session. So Wednesday's midweek update will be live. We'd love to have you join us. In the meantime, if you have any questions that pop up, feel free to email me directly, mike@netpicks.com, or you can leave a comment on the video or on the blog post. So enjoy the rest of your weekend, everybody, and we'll hit the ground running here early next week. We'll talk to you on Wednesday.